everyone, good evening. It's 5:30 on the clock, which means it's time for the Money Show, NSE Prosperous India special. India's first and only show that brings you market's top financial experts to answer all your personal finance queries. You guys must have read the newspapers yesterday, and it did certainly read something quite disconcerting, and that is India has been replaced by China as the fastest growing economy. India, which up until very recently was growing at a nice pace of 7%, has cooled down. The GDP growth has come in just at 6.8% for FY19. However, what is the implication of that on your portfolio? Should you consider giving your mutual funds a relook? Should you consider redeeming your mutual funds? These are the kind of questions that you guys must be having. Are the slowdown blues in India going to affect my portfolio? Today, that's what we are going to be discussing on the Money Show. And to take that conversation forward, I'm joined by Uday Dhoot, the co-founder of Venn Wealth. Uday, thank you for joining in. It's a pleasure having you with us on the Money Show. I want to start off first by getting in an overall perspective. We've been getting a lot of questions and queries on this very topic, that if GDP growth in India is slowing down, which is the key parameter, of course, of growth, of essentially how, people's investments as well would grow, does it mean that investors should give their mutual funds a relook, or worse, does it mean that they should consider slowly exiting any of their mutual funds?
Hi, thanks for having me. Let's just understand this in a bit more detail and step back a little bit. So first of all, the GDP growth number that we are seeing is a number, obviously, what has happened in the last 12 months. And investors should always be looking at what is likely to happen in the next 12 months or the next 24 months or 36 months, because that's how you make your money, not on what has happened, but what is likely to happen. Second thing is that when you look at GDP, GDP is made out of so many multiple components. There is agriculture part of GDP, there is banking, which is part of GDP, there is service, there is industrial, and so on and so forth. So there will always be certain parts which are doing well, there are certain parts which are not doing well. Now, is there a direct correlation that we can draw from mutual funds, what mutual fund investors should do from what GDP growth is? I would say no. For investors, their clear anchor is their financial goals, what returns they want to achieve, what is their investment horizon. So if somebody is thinking that, hey, I need to plan for my retirement 20 years down the line, frankly, what happens in the last 3 months of this quarter to the GDP is irrelevant. What you really need to be thinking is that, hey, how do I see things moving forward in the next 5 years, 10 years, 1 decade, and so on and so forth. So that's the first thing. So you, as an investor, start thinking where your goals are, what your investment time horizon is. Are you thinking short term? Are you thinking long term? And then sort of build. Secondly, and finally, when you're looking at GDP, you're essentially looking at the real GDP growth. To really get a sense of how the economy is growing, you need to add back inflation to that to sort of get, okay, what is the nominal growth in GDP? Net, I would say for many retail investors, frankly, looking at all of this macro data beyond a point actually does not make any sense. For you, as an investor, the focus should be on your goals, on your investment time horizon, on your risk appetite, and what kind of asset allocation you should have. Now let's look at GDP and the asset allocation. If I have a largely debt-oriented mutual fund portfolio and the GDP is slowing, there are chances that the interest rates are likely to go down, which is chances that my debt portfolio is actually going to do well. So that's one way to think about it. If on the other hand, let's say I have a completely equity portfolio, GDP is falling, does that mean that, hey, I should get out of mutual funds? I would say definitely not. Because your equity portfolio typically is a long-term portfolio, and you should not be perturbed by what has happened in the last 6 months or 1 year, and so on and so forth. So that's how I would like to think about it. Now finally, a lot of times people think that, hey, GDP is all about how markets are growing. Not necessarily. You see, today Indian companies might be selling all over the world, like an Infosys or a TCS, where they have maximum investments or maximum sales coming in from US and Europe. So how does the GDP growth in India actually deter what is happening there? They might actually be growing while GDP is slowing. There could be parts of the GDP itself which are growing. So you could see that, hey, in India, banking and financial services over the last few years has been growing very fast. So that could have a very different level of speed as compared to what is happening with the overall GDP. So I would say that don't look at too much of these macro numbers. Think long term, think through your goals and invest accordingly. Focus on your asset allocation. That should be the main thing for all investors.
Okay, all right. And yeah, the proof is in the pudding. That's some great data as well that Uday has actually put forward. You could see it on the left-hand side of your screen, how GDP growth and market return is actually deferred. And yeah, at this point of time, your longer-term goals, or rather at any point of time, your longer-term goals always do take precedence. Okay, well, I was just about to invite questions and queries. Our telephone line is, of course, at the top of your screens. You can call in, be a part of this show. And before I could do that, I've already got my first caller. But yeah, just a reminder for all our viewers, call in and you can be a part of the show live. Uday will answer all your questions and queries with respect to mutual funds that you own or are interested in owning. Jitendra from Faridabad is the very first caller on the show. Hi Jitendra, good evening. Thank you for calling in. What's your question?
Hi ma'am, I just want to ask which mutual fund will be the best for investors?
Do you have any investment goals? For example, you want to save for retirement?
No, I want to invest for like 10-15 years at least.
10-15 years. Okay, all right. Uday, what would you recommend Jitendra do? And if you have any counter questions, for example, about his age or anything?
Hey Jitendra, you sort of typically when I ask investors, I ask them saying that, hey, the good way to sort of think about your investments, I think how much return are you likely, what kind of returns do you want, what kind of risk are you willing to take, do you need any liquidity from this portfolio, as in would you need this money to be withdrawn, what kind of taxation are you looking at, what is your time horizon? These 5-6 things are very important, very basic. So is this the first time that you are investing, Jitendra? Hello?
You heard Uday's question, but he essentially wanted to know. Okay. Do we still have Jitendra on the phone line? Okay. Unfortunately, perils of live television, Uday, we've actually lost the phone line, so I don't know if you'll be able to, continue answering his question without getting that answer, or should we move on to the next one, Uday?
We can. Yeah.
Recommend Jitendra do then.
Yeah.
Okay, all right. You know what? We'll just we'll try and reconnect with Jitendra and see if he can answer that counter question. But in the meanwhile, let's connect with Johnson. He is from Kerala. And Johnson, hi. Good evening. What's your question?
Good evening, ma'am. See, I wanted to invest around 2 lakh rupees
Okay.
into the fund.
Okay. Again, Johnson, if you heard out Uday talking earlier as well, asking for some questions, he wants to know basically before he can recommend funds as to would you be needing this money, anytime soon? Secondly, what's your risk profile? Are you willing to take a high risk? Thirdly, what sort of returns are you expecting? And fourthly, what's your time duration? What are you investing for? Is it for your retirement, for your children's education perhaps?
No. It is for just 1 year or 2 years time horizon.
Okay, just 1-2 years. And that means you need the money in the next 1-2 years. Is that right?
If you have a 1 or 2 year horizon.
Go ahead with that.
Hi Johnson, if you have a 1 or 2 year horizon, I would say that it is best to stick with debt funds, debt mutual funds. So you could basically look at the low duration funds or the short term funds. So maybe you could invest in Franklin India short term income plan or ICICI Ultra short term fund or ICICI short term income plan. So you could basically look at these funds. They should ideally give you slightly better returns than your fixed deposit. And after 1.5 years, when you need the money, you could easily take it out from there.
Well, yeah, and of course, they are relatively a little more safer as well. So that, of course, is about debt funds. And yeah, whenever you do have a shorter term time horizon, it makes sense to stick to debt funds as opposed to equity funds. Johnson, I hope that's helped you answer your question. ARV Rao from Hyderabad is joining us now on the phone line. Hi, Mr. Rao. What's your question?
Good evening, madam. My question
Good
is with
evening.
regard to taxation of equity mutual funds.
Okay.
I just wanted to know, in case there is loss of capital on sale of equity mutual funds, can we set up that loss against the gains on debt funds or carry it forward to future years?
Both are long term, sir?
Yeah, both are long term, madam.
Okay. Uday, please advise him. Can he do a set off of that kind?
Yes, you can very well do the set off. Earlier it was not allowed when equity mutual funds were exempt from taxes, but you could very well do the set off now, long term against long term. And obviously, if there is no long term gains and you have long term losses, you can carry them forward.
Okay, not just set them off, but you can even carry them forward if you don't have any long-term gains to set it off against. I think some benefits, at least, of the taxation on long-term capital gains on equities, I suppose. Okay, I think it's Jitendra. Yeah, Jitendra has been able to reconnect with us. Jitendra, Uday had some follow-up questions. Like, for example, yes, you want to invest for the long term, but what sort of risk are you willing to take? And what sort of returns are you expecting from the market? So that's some follow-up questions he had, Jitendra. If you could just reply on that. Okay, pardon me. This is another Jitendra actually that's calling in. Well, what a coincidence, I must say. Jitendra ji, thank you. आपने The Money Show पे फोन किया. आपका क्या क्वेश्चन है उदय जी के लिए?
मेरा क्वेश्चन है
जी.
इमरजेंसी फंड के लिए को किसमें इन्वेस्टमेंट करना अच्छा रहेगा, मनी मार्केट फंड में या लिक्विड फंड में?
Okay, Uday, if you could help him out and if you could respond in Hindi, please.
देखिए, जो आप ये इमरजेंसी फंड बनाने की कोशिश करें, बहुत ही अच्छी चीज़ है। इमरजेंसी फंड टिपिकली आपका जो भी खर्चा है उसका 3 से 6 महीने का एक होना चाहिए। अगर मेरा महीने का खर्चा 50,000 रुपया है तो एटलीस्ट 1.5 से 2.5 लाख रुपया मेरे पास में इमरजेंसी फंड के दौर में होना चाहिए। आपका सवाल कि वो लिक्विड फंड या मनी मार्केट फंड हो, दोनों में कर सकते हैं और मतलब दोनों में किसी में भी कर सकते हैं। दोनों ऑलमोस्ट सिमिलर हैं, लिक्विड मनी मार्केट फंड। और अगर आप बिल्कुल सेफ होना चाहते हैं और चाहते हैं तो थोड़ा बहुत आप उसको स्प्लिट करके थोड़ा पैसा आप बैंक में भी रख सकते हैं, क्योंकि कई बार ऐसा हो सकता है कि आपको पैसों की जरूरत तुरंत पड़े। तो मेरे ख्याल से ऐसा कोई हार्ड एंड फास्ट नहीं है, रिटर्न में बहुत ज़्यादा डिफरेंस आने वाला नहीं है। तो चाहे आप लिक्विड फंड करें या मनी मार्केट फंड करें या बैंक में रखें, एक ही बात है, रखना इमरजेंसी फंड जरूरी है। और उसके बाद में कि समझ लीजिए आपके पास में 5 महीने 6 महीने का इमरजेंसी फंड है, जरूरी यह है कि उसके बाद में आपके पास में जो भी सेविंग्स हो उसको सही तरीके से आप डेट या इक्विटी फंड्स में आपकी जरूरत के हिसाब से इन्वेस्ट करें, ताकि आपको वहां पे बेहतर रिटर्न मिले।
जी जितेंद्र जी, ये याद रखिए या कि मनी मार्केट फंड में या एक बैंक के सेविंग्स अकाउंट में उतना रिटर्न आपको नहीं शायद मिलेगा जितना इक्विटी या डेट फंड में मिल सकता है। वहां पे भी ऑफ कोर्स लॉस की पॉसिबिलिटी है, लेकिन रिटर्न्स भी वहां पे कंपैरेटिवली ज्यादा है। ओके, वी विल जस्ट टेक अ वेरी क्विक, डू वी हैव मिस्टर एन चंद्रशेखर? Okay, N. Chandrasekhar now joins us on the phone line. Hi sir, good evening. What's your question?
Yeah, my question is like, I'm DS.
Go ahead, sir.
Yeah, I'm DS Chandrasekhar, not N. Chandrasekhar.
Oh, okay.
And
okay, sorry. Yes.
No, it's okay. My question is like, I keep buying shares on cash. Cash buy and cash sell basis.
Okay.
And is it okay, like, doing this way of business, stock trading, like, and also, I do mutual funds, tip every month 1,000 rupees.
Okay.
In about 5-6 good mutual fund houses. So is that okay, like, if I continue to do this?
Okay, so you have share trading and you have mutual funds as well. Is that right, sir?
Exactly. And I wish to know, like, is it okay, like, share trading, I'm doing cash sell and cash buy. Each time I buy and sell.
Okay, so you have share trading and you have mutual funds as well. Is that right, sir?
Exactly. And I wish to know, like, share trading, I'm doing cash sell and cash buy. Each time I buy and sell.
Okay, Okay, honestly, this would require something that's more, I don't know how much Uday would be able to help you out since he does not have more details about you. But Uday, if you could just give a rough understanding of, how mutual funds work vis-a-vis how, cash trading and, spot trading work, because two are from widely diverse universes.
See, Mr. Chandrasekhar, my experience working with investors has told me that the best outcome the investors make out of their investments is when their investments are aligned to their goal and to their behavior. Not everyone can be a great trader in the stock market, and not everyone can hold long-term investment. So basically, somebody who marries his goals and his investment behavior, or at least brings in the right type of investment advisor to work with him so that his goals are married to his investments, gets the best outcome. Now, as your question says, that at one hand you are doing this day trading, cash selling, cash buying, and the other hand you are investing in mutual funds for the long term, and is this the right strategy? Frankly, the right strategy depends on what your goals are and how much you are allocating to share trading versus how much you are allocating to mutual funds. I would say for most investors, staying with mutual funds, letting them let the professional fund managers pick up what shares to buy, what shares to sell, would be the best thing to do. Some people do take keenness to sort of trading. I would say that if you are somebody who's trying to learn, who's generally excited about saying that, hey, I want to be on top of what is happening, I would say allocate a small percentage of your portfolio to this trading portfolio. Do not allocate a lot of money to this portfolio, because typically what happens is that people end up investing more and more money here, and in generally sort of then don't get a great outcome. So be very, very particular of how much money you allocate here if you're doing this purely from a learning perspective. But if you're thinking of making long-term money, whether it is shares or mutual funds, it is basically buying good investments and holding them for the long periods of time, which is what is going to make you long-term money.
Yeah, share trading, there always exists that possibility of 100% capital loss. So allocate only a fixed amount and a small amount compared to your entire portfolio. Majority, keep it away in mutual funds, because that certainly is a long-term wealth generator. Okay, finally, we'll be able to just take a quick breather right here on The Money Show, but don't go anywhere. We have more questions and queries that we're going to answer when we return from this short break. Good evening and welcome back. You're watching The Money Show right here on ET Now, where we are talking about mutual funds and how, India's slowdown in GDP growth may not exactly impact your mutual funds on a very direct way. Uday Dhoot is with us on the show and he is answering all your questions and queries. And our phones have been ringing off the hook. So without any further ado, let me bring on board our next caller. S. Nandi from Chennai is joining us now. Mr. Nandi, thank you for calling in. What's your question?
Namaskar.
Namaste.
I am a retired person, so
Okay.
I like to know how to allocate my total investment in different portfolio percentage-wise, like equity, NCD, fixed deposit, mutual fund. If you can help me out in this regard.
Okay, all right. Basically, portfolio allocation. Uday is already retired. What would be the optimum portfolio utilization, portfolio allocation for him?
Mr. Nandi, thank you for your question. The allocation depends on multiple things. One thing, but a few things that I would like to say generally that are very important for anyone who's retired is that having just retired does not mean that you should become, or your portfolio should become completely safe and all be invested in fixed income instruments, because even at the age of 60 one might end up living until 85, so which means that you have almost 2.5 decades until which your investments and savings should work for you and provide you those monthly expenses. So the first thing that you need to get hold of is that what are the monthly income or the monthly expense that you require out of your portfolio that needs to be provided to you on a regular basis. So that's the first thing that you need to get a clear sort of understanding of. Once you have figured that out, then you say that, hey, how do I ensure that at least the next 3 to 5 years of my regular expenses are protected? So let's say if you have 100 rupees in the portfolio, the way you work the portfolio around is that you ensure that at least you have very clear visibility of how the money is going to come in in the next 3 to 5 years, because that is typically the cycle of one market cycle would be say 3 to 5 years. So even if you have allocated money to equities and markets go down, you know that hey, next 3 or 5 years I won't be bothered because I have enough money allocation to safer instruments to take care of my regular expenses. Once you have done that, then you need to take the other part of your portfolio and start building a equity or a growth portfolio, which ensures that over a period of time, as your expenses go up in retirement, you have investments which are growing ahead of inflation, so that your lifestyle kind of remains protected. So that's how you sort of need to think of your portfolio over the next 2 to 3 years, how you're going to take care of your expenses, and over the next 5 to 10 years, how you're going to ensure that your portfolio grows ahead of inflation. Apart from this, what you also need to take care of is to make sure that you have enough emergency fund for any kind of health emergencies or any such things that you have. If there are any specific goals that you have planned for yourself, which is basically either gifting the money to somebody, going for holidays, make sure that you have money allocated separately for those items. So think about through those goals. Retirement or working is independent. You have to think through your goals and how you want to use the money, and then basically plan the assets. Again, like I said, age is just a factor. You still have maybe 10 years, 15 years, 20 years of investment horizon, which means that you should have a balanced portfolio of equity and debt. Again, that depends on where your numbers stand as of today.
Okay, and of course, Mr. Nandi, very soon we're going to be hopefully planning a retirement special as well on the Money Show. So you should stay tuned to TMS for the next couple of days, or in fact, for some time now. I wouldn't advocate you tuning out of the Money Show anytime soon. Okay, let's just try and get some email queries as well answered now. We have Sachin Gupta, who has sent in a question. He says, I would like to invest in a mid-cap fund in the current scenario. Please suggest which method, lump sum or SIP, would be better, and also a suitable mid-cap mutual fund to invest for the long term. Uday, what would you advise Sachin?
See, if somebody has an existing equity portfolio which is heavily allocated towards large cap and multi-cap funds, it might make sense for that person to actually do a lump sum switch into mid-cap and small-cap funds. But for somebody who's regularly saving and building a portfolio, then obviously you have the SIP, STP route to go through, in which case you sort of have no option. But if you already have equities which are largely large cap, etc., then I would say that hey, some amount of switching from large cap to mid-cap might make sense at this moment, given the fall that has happened in the mid caps over the last 12 to 18 months. In terms of funds that one can look at or think about, I would say that hey, you could look at HDFC Small Cap Fund, Franklin India Smaller Companies Fund. There's a new fund, Edelweiss Small Cap Fund, which has been around for 6 months, but which has a very good track record on the mid cap side. These are funds that you could look at for your mid cap exposure.
Okay, all right. I hope, Sachin, we've been able to answer your question. Unfortunately, we'll have to pack it up right here on this show. 30 minutes are done and up. Uday, thank you for so patiently answering all the questions and queries that we've been getting in. Lots of calls, I must say. And of course, keep sending in your questions and queries, folks. We will be right here on The Money Show on a daily basis. Until then, happy Eid to all of you. And of course, thank you for watching.